What if I told you that some of the world's brightest financial minds, Nobel Prize winners, even, created a system so powerful, so calculated, that it almost guaranteed success, until it didn't? Picture this: a hedge fund so influential, its fall nearly brought down the global financial system. This is the story of when genius failed, Roger Lowenstein's captivating account of long-term capital management, a hedge fund that flew too close to the sun. It's a gripping tale of brilliance, arrogance, and ultimately, failure. A cautionary tale for anyone who believes the markets are predictable. In today's video, we'll dive deep into Lowenstein's masterpiece, breaking down each chapter to uncover how hubris, overconfidence, and blind faith in mathematical models led to one of the greatest financial collapses of our time. But first, don't forget to subscribe, like, and share this video if you enjoy engaging summaries of timeless books. Let's get started. Setting the stage: the genius behind LTCM. Long-term capital management, LTCM, was no ordinary hedge fund. Founded in 1994 by John Meriwether, a legendary Wall Street bond trader, LTCM assembled a dream team of financial minds. Among them were Myron Scholes and Robert Merton, Nobel laureates celebrated for their groundbreaking work in finance. They believed they had cracked the code of the financial markets with mathematical models that could calculate risks and predict returns with astonishing accuracy. Lowenstein opens the book by painting a picture of unshakable confidence. LTCM wasn't just any hedge fund. It was an institution built on the belief that genius could conquer chaos. Armed with their models, they believed that the market was rational, that risk could be contained, and that they were untouchable. But as we'll soon learn, no model can account for the unpredictable nature of human behavior or the complexities of global financial systems. Chapter 1. The Birth of an Empire. The first chapter takes us back to the early 1990s, when John Meriwether left Salomon Brothers under a cloud of scandal. Determined to make a comeback, he founded LTCM with the ambition of creating a new kind of hedge fund, one that would rely on quantitative analysis and mathematical precision. Investors were dazzled. Who wouldn't be? With Nobel Prize winners on board and a strategy that promised sky-high returns with minimal risk, the fund quickly attracted billions in capital. Lowenstein brilliantly narrates how LTCM's founders believed their models could reduce financial risk to a science. Their approach was to exploit tiny inefficiencies in the market, betting heavily on spreads they believed were mispriced. The allure of this strategy was its elegance and its supposed invincibility. Chapter 2. The Golden Years. For the first few years, LTCM performed spectacularly. The fund achieved annual returns of over 40%, astonishing even seasoned investors. This chapter feels almost like a celebration of genius in action. Lowenstein describes how the team's strategies seemed to work like magic. Investors, from pension funds to global banks, couldn't hand over their money fast enough. But beneath the surface, cracks were forming. LTCM's strategy depended on leverage, borrowing vast sums of money to amplify returns. While this worked wonders in a stable market, it left them exposed to catastrophic losses if conditions turned against them. Chapter 3. Arrogance takes hold. As LTCM grew, so did its founders' arrogance. By the late 1990s, they were managing over $100 billion in borrowed capital, and their confidence was unshakable. They believed their models were infallible, and they dismissed critics who warned of potential risks. Lowenstein reveals how this overconfidence led to a dangerous feedback loop. The more they succeeded, the more they doubled down on risky strategies. This chapter also highlights a critical turning point. LTCM began taking on riskier bets, moving beyond their original strategy. They expanded into equity markets and emerging markets, areas far outside their expertise. Hubris had blinded them to the limits of their own knowledge. Chapter 4. The Beginning of the End. By 1998, the tides began to turn. In this chapter, Lowenstein masterfully builds tension as we watch the financial environment grow increasingly unstable. The Russian financial crisis was the first domino to fall. When Russia defaulted on its debt, global markets spiraled into chaos. Suddenly, LTCM's models, which relied on the assumption that markets would behave rationally, stopped working. Lowenstein details how LTCM's bets backfired spectacularly. Their highly leveraged positions, which once amplified gains, now amplified losses. The team, once seen as untouchable, was suddenly scrambling to survive. Chapter 5. The crisis unfolds. As the crisis deepened, LTCM's losses mounted. By the summer of 1998, the fund had lost nearly 50% of its capital. Lowenstein recounts how the firm's leadership remained in denial, clinging to their models and refusing to admit the scale of their failure. The irony, as Lowenstein points out, is that LTCM strategies were supposed to minimize risk, but in reality, they had concentrated it to catastrophic levels. This chapter is particularly gripping as Lowenstein describes the domino effect of LTCM's collapse. The firm's interconnectedness with major banks and financial institutions posed a systemic risk. If LTCM failed, the entire global financial system could unravel. Chapter 6. The Rescue. The climax of the book comes as the Federal Reserve steps in to orchestrate a bailout. In September 1998, Wall Street's most powerful banks gathered in a dramatic meeting at the New York Federal. The stakes couldn't have been higher. Lowenstein vividly describes the tension in the room as the banks debated how to save LTCM and, by extension, themselves. Ultimately, the banks agreed to inject $3.6 billion into the fund, taking control of its assets in the process. LTCM was saved, but at a steep cost. Its founders were humiliated. Its investors suffered massive losses, and the illusion of invincibility was shattered. Chapter 7. Lessons learned or not. In the final chapter, Lowenstein reflects on the broader implications of LTCM's collapse. He argues that the failure of LTCM wasn't just the result of bad luck or poor timing, it was a failure of judgment. The belief that mathematical models could predict and control markets was fundamentally flawed. This chapter feels like a wake-up call, not just for Wall Street but for anyone who underestimates the complexity of financial systems. Lowenstein warns that the same forces that led to LTCM's downfall, overconfidence, greed, and a blind faith in technology, remain pervasive in the financial world. Closing reflections. The story of LTCM is a modern-day tragedy, a cautionary tale of hubris and the dangers of overestimating our own intelligence. Roger Lowenstein's When Genius Failed is more than just a book about finance. It's a deeply human story about the limits of knowledge and the unpredictability of life. If there's one takeaway from this book, it's that no amount of brilliance can completely eliminate risk. Markets are influenced by human behavior, and as we've seen time and time again, humans are anything but predictable. And that's the story of When Genius Failed by Roger Lowenstein. A powerful reminder that even the brightest minds can falter when they lose sight of humility. With that said, thanks for watching, and until next time, don't forget to subscribe, like, and share this video for more engaging book summaries. See you soon.